Hey everybody, Marty Mazzora here once again, October 13th, Friday, 2023. This one's your economic update. I can keep this one pretty quick. I actually only loaded up 3 slides, although they're going to provide for sufficient narrative, I think, to give you the general picture. And then I'm going to, with the help of Peter Bookvar, share with you some of the details from a few of this week's earnings announcements and conference calls. So starting first though with the PW index, we actually stayed even on the week at a negative 21.28, so we're still in that range that says recession is more likely than continued expansion over the coming months. Let's just jump right into the CPI and PPI figures for September that were released on Thursday for the CPI, Wednesday for the PPI. Talked about this earlier in the week as well. As for the producer price index, it was up 0.5% month on month. Core was up 0.3%, and the estimates for those were 0.3 and 0.2% respectively. 3.3% jump in energy prices after a 10.3 spike in August drove the headline print, but food prices were also up 9%. Remember, the core X's out food and energy. Goods prices, ex food and energy, were up a more modest 0.1% month on month, higher by 2% year on year. Service prices grew by 0.3% month on month, or 2.9% on the year. As for the CPI, rose 0.4% month on month, and that was after a 0.6% in August. The core rate was higher by 0.3% month on month. That was pretty much what we had in August. Year-over-year gains were 3.7% for the headline, and that was the same as the month before. Core was up 4.1 versus 4.3% in August. Energy prices were up 1.5% month on month, 5.6% jump in the month before, but flattish on a year-on-year basis. Food prices were up 0.2% month on month and 3.7% year-on-year. Services inflation ex energy was up 0.6% month on month, 5.7% year-on-year. Still reflecting high rental increases in a very lagged fashion, quote. On the good side, core goods prices fell by 0.4%. Number 2 and number 3 of the slides, we're going to talk about sentiment. The National Federation of Independent Businesses, also known as the Small Business Survey, the optimism index fell 0.5 point to 90.8. That's a 4-month low. The internals were mixed. The average cost of capital rose to 9.8 from 9% the month before. The bottom line, and this is right from the report, owners remain pessimistic about future business conditions, which has contributed to the low optimism they have regarding the economy. Sales growth among small businesses has slowed, and the bottom line is being squeezed, leaving owners few options beyond raising selling prices for financial relief. And I would say, as long as they can get away with it, as you can see, capital expenditure plans were flat, and still a little tick up here in hiring plans. And of course, the complaint is finding qualified people who want to come to work. So again, nothing at all inspiring about the small business sentiment survey. And then as for consumer confidence, the University of Michigan, their initial October survey really kind of fell out of bed here. And that was below expectations. That's a 5-month low. Both key components, current conditions and expectations, were down. 1-year inflation expectations jumped to 3.8% from 3.2. That's a 5-month high. Also, the 5-10-year inflation guess was up 0.2 month on month to 3%. Employment expectations did rise 2 points, but after falling by 5 points last month, and the income component actually softened. The median percent of those who think their income will exceed inflation in the coming 5 years fell to the lowest since July of 2022. Spending intentions were mixed as they did rise for a home by 3 points, but that's after dropping by 5 points last month. They declined by 4 points in terms of intentions to buy a vehicle, to the lowest since November of 2022. Major household items, there was no change in the month-over-month view there. After stabilizing earlier this year, concerns about inflation, and this is right from the report, concerns about inflation have grown again. These concerns underpin the sharp 15% deterioration in consumers' assessments of their personal finances this month. About 49% reported that high prices are eroding their living standards, up substantially from 39% last month and matching the all-time high last recorded July 2022. They pointed specifically to the prices of food and groceries. So folks, these are conversations that we're having internally. You know, when you look at some of the data, enough of it, you understand where these bullish soft landing narratives come from. And when I talk to people, it's like, hey, when we're out and about, we see people out spending, we got to wait in line to spend $20 on a breakfast burrito like my wife did the other day, you know, things like that. And it's like, yeah, people are still spending a lot of money. Of course, we're looking at the credit card data and that sort of thing, and we're seeing that, you know, people are hitting their credit cards. What we're hearing from particularly the retail sector is people aren't buying the fluffy stuff, the discretionary, the fun items, as much as they are buying essentially just what they need. So what we've been talking a lot about internally is, you know, you just have to wonder if we're just not going to kind of wake up someday when there's just going to be an abrupt halt to consumer activity and therefore to economic growth. So our recession thesis going into next year, as we sit here today, isn't going anywhere. And that doesn't bode well for asset prices, as I expressed in the earlier video today. And clients, please, if you didn't watch that, take the 15 minutes or so that it takes to go through that one, or at least up to the point where I give you the heads up that I'm going to now get into the weeds of the technicals. Really want clients hearing our narratives right now. Okay, so as for some earnings highlights, JP Morgan, right from their commentary, currently U.S. consumers and businesses generally remain healthy, although consumers are spending down their excess cash buffers. However, persistently tight labor markets, as well as extremely high government debt levels with the largest peacetime fiscal deficits ever, are increasing the risks that inflation remains elevated and that interest rates rise further from here. I've got a little different take on that, as I shared earlier today. Additionally, we still do not know the longer-term consequences of quantitative tightening. I mentioned that earlier, the fact that the Fed is committed to keep doing that for the foreseeable future, which reduces the liquidity in the system at a time when market-making capabilities are increasingly limited by regulators. Furthermore, the war in Ukraine, compounded by last week's attacks on Israel, have far-reaching impacts on energy and food markets, global trade, and geopolitical relationships. This may be the most dangerous time the world has seen in decades. That's Jamie Dimon. I quoted him in the earlier video as well. Wells Fargo, while the economy has continued to be resilient, we are seeing the impact of the slowing economy with loan balances declining and charge-offs continuing to deteriorate modestly. Fastenal, another earnings report this week, quote, frankly, the dynamics of the quarter varied little from the second quarter of 2023. Macro data points and feedback from the regional leadership continue to point to sluggish demand and a cautious outlook for spending and production. You've been hearing that here for a while. From Pepsi, I do think that we see the consumer right now being more selective, and you see it in a variety of ways, right? You see some trade down in terms of channels of trade that they're purchasing products in. You see some orientation toward value. We think our revenue outlook accommodates an increasingly cautious consumer next year. Remember what I said earlier. Probably going to hear really good earnings reports for Q3. But like Pepsi just hinted, if we get earnings outlooks that are ratcheted down out of caution for what they think the economy is going to look like going forward, that could actually kind of turn the character of the trading to where suddenly the market is trading consistent with our go-forward thesis here for a while, and that is that if the recession does hit, earnings are going to decline, And a lot of the stocks that are traded in these index, certainly the top ones that are really making all the difference, they're not priced for a recession right here. So folks, yeah, this is all very consistent with what we've been saying and what we've been seeing in the indicators. The equity market and, and asset markets in general have really been just hyper-focused on the Fed. Therefore, weak economic data means the Fed can back away, which is interpreted as bullish. Ultimately, it's not, if indeed the economy is going to slow and earnings are going to slow. And I keep saying that over and over again. And as long as that's the setup, we'll continue to emphasize that point and allocate our core portfolio accordingly. So folks, I'm going to leave it there. Thank you, as always, for watching and listening. Hope you have a wonderful weekend. And if I'm not back before, look for the Monday morning written note. Take care. Bye-bye.